Hi, I'm Daryl Jones, Director of Research at Hedgeye Risk Management, and I'm very pleased to have joining us today Doug Cliggott. Doug has had a very prominent Wall Street career as an equity strategist at such firms as Merrill Lynch, Credit Suisse, JP Morgan. He's now back at his alma mater, back to academia at UMass Amherst Economics Department, teaching and lecturing. And we're excited to have him joining us today, and we're going to, kind of get right into it. And we have a series of questions for you, both about your career, about the economy, and sort of what you think is going to happen prospectively. But really the first question here is, you've recently returned to academia, but presumably still follow markets pretty closely. So we'll just get right into it. What's your sort of view on U.S. equities and the U.S. stock market?
I think, Daryl, we're in a really high risk period for equities now, and some really simple relationship that we've looked at for many years, but seems to be pretty powerful, is comparing where we are in the corporate credit cycle with where we are in the corporate profit cycle.
Yep.
Both measures are really cyclical, but they don't go up and down at the same time. When we look back in time, say 2010, 2011, 2012, very healthy environment. Profit growth was significantly faster than credit growth. Last couple of years, and so far in 2015, we've had a reversal there where corporate credit is growing a lot faster than corporate profits.
Yep.
And that tends to be a real warning signal for equity investors. What it really means is some of the activities the corporations are borrowing money to buy aren't generating profits.
Right.
And that's sort of that's what happens just before you actually see declines in corporate profits.
Yep.
And actually S&P profits are pretty stagnant this
Yep.
year.
Yep.
A lot of leading indicators of profits, both here and around the world, are weakening.
Right.
So I'd say the easy thing to say is if you're putting new money to work now,
Yep.
you shouldn't expect much of a return on it.
Right.
And there's, I'd say an uncomfortably high probability that we actually could get a pretty significant correction here.
Right. Gotcha. We were talking before the cameras came on about the Fed and their role in this. On some level, what they're trying to do, I think probably they're trying to do the right thing. But what do you think about the Fed's predicament right now? I mean, to us, it's always been like they're in a bit of a box. They can't really make a move from here if there were a correction. They don't have a lot of tools left, but they've also sort of put us in the position we're in on some level too. I'm just kind of curious to get your thoughts.
Yeah, boy, don't envy the position they're in.
Right.
As you said, it seems they're really trying to do the right thing, right? They're trying to do whatever is in their power to bring down the unemployment rate, strengthen the labor market. But when we think of the tools that they have, they can move interest rates. They can't really move them down anymore. So
right.
They do that to try to influence our borrowing behavior, us as individuals
Yep.
and as corporate treasurers. And the other thing they've done in this last cycle is, in a very straightforward manner, manipulated asset prices, trying to
Inflate
asset prices.
Yep.
But when you map that into, okay, what happens when you do that? As we talked about earlier, we see corporates are borrowing. Corporate credit growth is growing, but when we see what corporations are doing with their money, if we go back and look at the 80s and the 90s, corporations were spending about 90% of their after-tax cash flow on capital investment.
Right.
That went from 90% down to about 80% in the 2000s, sort of the first decade. In the last 5 years, that's gone down another notch. So
right.
now corporations are only spending about 70% of their after-tax cash flow on CapEx. And they've sort of mirror image of that. They've gone from about 25% of cash flow returning to shareholders up to 35%.
Yeah.
Now they're over 40%.
And is part of this the advent of activist investors who, are pushing companies to return cash? I mean, a lot of activists. There are a few exceptions, but a lot of activists want sort of the quick return on their money, right? So they want a special dividend paid. They want stock to be bought back versus actually investing in the economy and investing in companies. Do you think that's part of the challenge?
I think that's part of it.
Yeah.
I think part of it is just, basic human nature
Right.
in the way we've set up incentive systems. If you're top management in a large corporation and you have billions of dollars to put to work, you've got some choices. Do I invest in new technologies that may or may not give a payback? Do I build a new factory that maybe I need it, maybe I don't? Or do I buy back a ton of stock? Remember, my compensation, not just my activist investors, my compensation is tied to my stock price.
Right.
So if I'm looking to sort of maximize return and minimize risk, a share buyback program is really attractive.
Right.
But the downside of that, something that I think is unbelievably sobering, is if we look at a very important real economic indicator, productivity growth.
Yep.
In the last 5 years, productivity growth in America has averaged about 0.5%.
Right.
I don't think anyone has a total explanation for that, but I believe part of the explanation has to be this ratcheting down of CapEx.
Yep.
And a shift in focus to share buybacks.
Right.
So, if you're not investing in new technology, if you're not building new factories, and sort of circling back, that puts the Fed in a bind, right?
Right.
Because with productivity growth so weak,
Yep.
the trend rate of growth, the potential growth of the US economy has really come down a lot.
Yeah.
We might not have an output gap at all right now.
Right.
We might be growing this sluggishly because this is the speed limit of our economy
The
now.
new normal or whatever.
And it's like, wow, that is such a different image than I think all of us had 3 or 4 years ago about what our potential growth rate was.
It's very true.
So I don't think it's just the activist investor. And sort of doing research in this area, something that surprised me, the SEC essentially didn't allow large-scale share buybacks until 1982.
Oh, interesting.
Prior to 1982, it was their view that it was sort of overt market manipulation by a corporation, that they had sort of inside information, and that maybe might not be the right thing to do. And so when you look at the long-term data on cash flow going back to shareholders, it's almost like there's a break in the series that it shifts up in the 80s.
Right.
And then once top management started getting paid primarily with shares and options, so the compensation linked to shares, which happened in the 90s, now we're going sort of parabolic in the amount of money going back to shareholders.
People basically do what you pay them to do. Right?
That's right.
Yeah.
And so, as weird as it might sound, one way to really get the trend rate of growth of the US economy turning up, productivity turning up, would be to seriously consider the idea of, let's not do share buybacks anymore.
Right.
Let's use profits to invest in business.
Right.
And
cap share buybacks.
Do something, because it seems the model we're running with right now, it's just not doing a lot to trigger reinvestment in the real economy.
Yeah. This is more of a philosophical question, but why do you think there's often such a disconnect between the direction of the market and the direction of the economy?
Well,
and I'm sure you've seen this, in your career a number of times, particular, probably the early 2000s, where you were more on the bearish side versus a lot of Wall Street, and you were eventually right, but for a period of time, sort of the stock market's doing something that doesn't seem to match what the underlying fundamentals of the economy are.
Right. Well, I think there's sort of two different directions to think about it.
Yep.
First is, we don't buy and sell GDP.
Right.
We buy and sell corporate profits. So sometimes, like early in this cycle, we had tremendous growth in profit, which is what we should value equities on. without a lot of economic growth. And
Yep.
it was essentially because margins were going up so rapidly and the profit share of national income was going up so rapidly. So in that sense, it was weird, but it was normal. You know, we're buying or attempting or hoping to buy an income stream when we're buying equities that over the long haul mirrors pretty well economic growth, but in fairly 2-3 year periods of time, they can diverge pretty rapidly.
Yeah.
But going the other way around, and this is in a sense another reality or dilemma that the Fed is confronting. When you look at equity exposure or equity ownership in the United States, and this data is from the Fed's survey of consumer finances from 2013. 5% of the American families, literally just 5% of American families own 91% of equities.
Right.
Broaden that out to the top 10%, own 96% of all equities. So this idea that there's a wealth effect from the equity market feeding into the economy for people that have had a lot of good fortune, have accumulated a lot of wealth, yes, there can be a wealth effect. But for 90% of the American population, the idea that there's a wealth effect from the equity market, is really hard to measure. And I think the other factor, sort of linking it to an earlier topic, it's not clear at all. When I was an undergrad and a graduate student, we focused on this thing called the Tobin-Q ratio, thinking that when a company's stock market value went up, that would trigger investment in physical plant and equipment, and that was the mechanism to bring them back in alignment. Sadly, we just see Tobin's Q growing and growing and growing. There doesn't, in the world today, it doesn't seem to be a linkage between higher stock market values and in real investment in the economy.
Yeah. So again, we were talking about this earlier. The Fed and frankly, a lot of forecasters tend to look at or reflect on backward-looking indicators, which employment tends to be, as an example. What are sort of indicators that you focus on or take a look at to sort of both inform your forecasts and have a sense, and there are probably a lot of them, but a sense for how things are going in the underlying economy that, I think employment in particular is one that people seem to focus on, but really it's sort of a lagging versus leading indicator.
I think if you're a policymaker and you're trying to look ahead, I think if you're a central bank, a relationship that we spoke about earlier, looking at the relation between corporate credit growth and corporate profit growth, that might seem to be a good one. Because again, they can directly influence corporate credit growth. And where we seem to have got ourselves, not just in this cycle, but we found ourselves here in 2007, we found ourselves here in 99, 2000, that the Fed starts tightening financial conditions at exactly the wrong time. Right? Because you're in a very mature credit cycle. You've already seen a significant weakening of profitability. And sadly, I don't think it's a coincidence that the last two equity bear markets we've had, 2000 to 2002 and 2007 to start 2009, those are the two most vicious bear markets we've had in the post-war period. And so I think maybe it's a very long-winded way of saying maybe the central bank, maybe the Fed simply doesn't have the tools for managing the economic cycle. That if as a society we feel it's appropriate to manage the cycle, the right tools are actually fiscal policy. and that's almost become a dirty word
Right.
now. Somehow, some way, austerity and this unbelievable focus on no, we can't let government debt grow.
Yeah.
And I guess I'm sympathetic to the idea that you can't just let debt grow to the moon.
Right.
But
there are times.
There are
Yeah.
times where
Yeah.
I think an activist fiscal policy is absolutely,
And maybe more effective. Yeah.
especially in an environment that we appear to be in, where households still have huge amounts of debt.
Yep.
Where corporate debt growth doesn't seem that linked with investment growth right now, so that if the effort is to somehow, some way get larger segments of the American population seeing their incomes grow,
Right.
maybe the only way to really do that is fiscal policy.
Yeah. Got a couple more questions for you here. I'm going to veer a little bit off topic just because it's really so topical this week and going to get more topical. But what are your thoughts on the election? And the election, of course, will have an impact on the economy and policy. But it's sort of a fascinating time you have on the right. I think we had 10 people on stage in the debate on Wednesday, and then on the left, you seem to have a bit of a coronation. But how do you think this all plays out, especially in conjunction with economy that's probably going to be getting worse into the election?
Yeah, no idea.
Yeah.
I wish I did. I guess what I think I know,
Yeah.
that's always dangerous. What I think I know is that I believe the dominant theme of American politics, probably for the foreseeable future, is going to be inequality.
Right.
and how we deal with it, and how we find solutions to it that are sort of positive for almost everyone involved.
Right.
Because I think, trying to link this to earlier in our discussion,
Yep.
Higher equity prices seem to be benefiting a very narrow segment
Right.
of our population, and not doing a lot for economic growth, or more importantly, investing in the future of the country.
Yep.
I don't think there's one or even two or even three singular solutions to how we got here, but our economy on many, many different economic metrics looks uncomfortably similar to a 19th century economy or a 1920s economy.
Yep.
And so I think whatever candidate or candidates can come not with sound bites,
but
with what
plan.
appear to be some compelling, concrete.
That can lift the entire economy up. Yep.
Yeah.
Yep.
And some of these things might actually need to happen at the state and local level.
Yeah.
It would probably make sense, as everything does, to work on a bunch of different levels. But it would seem to me that's probably will be the defining, but again, maybe not just for 2016, but
ongoing.
I think so, if only because, when you look at a lot of social realities that I don't think any of us are very comfortable with, what a high percentage of our population is in prison, what a high percentage of our population isn't in great health, the fact that Americans tend to die earlier than people in almost any other advanced economy in the world. There's lots of explanations for these, but one that is very powerful and uniform is they're all linked to the degree of income inequality within the country.
Yeah, that's a very good point.
And so,
fixing that potentially fixes a lot of things.
That path going there will probably address and fix quite a bit of things along the way.
Yep. So last question we have for you here, and we're going to take it back to the markets and investing, but What are your sort of top 2 or 3, I guess, either asset ideas or maybe even stock ideas if you have them, but if you're advising somebody what to do right now, what would it be?
Well, that's a great
I mean, you're obviously
question.
pretty bearish again, so I mean,
Well,
maybe
but
the answer is not much.
I think the honest answer is not much.
Yep.
If you have to be in, the reality is a lot of people have jobs. If you're a long-only equity mutual fund manager, you can't really go to work, sort of punch the clock and say, I'm going to all cash.
Right.
That's not your job.
You got to be invested.
It's like you can't go to the firehouse and say, I'm not going to go to fires today.
Yeah.
So I think there, it's to invest in low cyclicality.
Yep. So staples potentially.
Staples, healthcare, where you would normally hide out
Yeah.
when at the end of a profit cycle.
Yeah.
One thing that's really interesting and why I think the risk of the market as a whole declining is significant is besides staples and healthcare, another place you normally want to hang out late cycle is energy. And
Right.
not this one.
Energy, just forget about it.
We just don't know how much overinvestment
Yeah.
has occurred. You never know that until the other side of the cycle.
Yep.
Right?
Yeah, it's very true.
And so, again, I think it's pretty narrow. I'm still primarily focused on the U.S., but when I look at leading indicators of growth around the world, sort of the standout right now, believe it or not, looks to be Europe.
Standout on the positive
On the positive
yeah.
side. They sort of slowed down pretty aggressively, and
Yep.
a lot of European economies seem
Making
to be
the
bottoming
positive inflection.
at
Yeah.
positive inflection points. Just as we and Canada, China,
Yeah.
um,
Or going the other
unfortunately,
way.
our inflection points seem to be
Turning over, yeah.
turning the wrong way.
Yeah.
So again, with the caveat that I'm just looking at data that's pretty reliable, but it's not a real focus. I focus a lot on the U.S.
Yep.
And so I'd say
Makes sense.
healthcare, staples,
Yep.
and maybe industry groups that have pretty nice moats around them.
Yep.
Stable businesses like maybe defense stocks.
Yep.
They're probably not that different from consumer staples in that I'm not sure there's going to be any huge political constituency to dramatically reduce the defense budget.
Right.
But that won't sneak up on us.
Yep.
As an
Very true.
investor, you can sort of back away
See
from
that
that.
coming,
If,
yeah.
yeah.
Great. Well, thanks a lot for joining us today, Doug. It was a great conversation, and hopefully you can come back again sometime.